Extremely bullish on gold. Again, that could be talking my book, but I try to remain objective because I didn't come into gold because I wanted to work in a gold company. I came into gold because I made money on the S&P as a speculator, as a hedge fund manager, and I realized that gold made more sense than fiat money. Bitcoin makes more sense than fiat money. Gold is just more stable for me. In terms of what happens with gold, even if you take my thesis, I'm completely wrong. Gold wins either way. Preservation or speculation, I think gold can do well in both categories. Always, for me, it's a preservation asset. But, if gold goes from 2,100 to 4,200 in a year or a month or a day, you have to understand, too, that also means the price of just about everything else has gone up, too. So it's kind of an interesting consideration.
Since the creation of the Federal Reserve in 1912, the U.S. dollar has lost nearly 98% of its purchasing power. The gold price, on the other hand, has multiplied 100-fold. This may seem like a lot, but gold has just maintained its purchasing power. Today, 1 ounce of gold purchases approximately the same goods and services it did 100 years ago. MatthewPiepenburg, the co-author of Gold Matters, is bullish on gold due to objective analysis and a preference for its stability over fiat money. He emphasizes that gold serves as a preservation asset. If its price doubles to $4,200, the same applies to all other assets. Currently, gold is trying to do everything it can to break out to the upside and hit fresh new highs, and 2024 is more likely than not expected to continue to be extraordinarily volatile. Meanwhile, Matthew views gold as a resilient asset, poised by whether central banks print more money or allow the bond market to unfold naturally. The ongoing downfall in the U.S. Treasury bond yields and the risk of further escalation of geopolitical tensions in the Middle East lift the gold price higher for the second straight day. Despite the absence of conventional tailwinds such as negative real rates, inflation, and a strong dollar, he observes gold achieving all-time highs. Over the past 2 decades, gold prices have experienced 4 bull cycles, driven by elevated market uncertainty and the increase in geopolitical factors. Matthew highlights the likelihood of higher inflation and advises active management in the face of volatility. Now, we present the clips of MatthewPiepenburg's insights from his recent interview with Investing News. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
Extremely bullish on gold. Again, that could be talking my book, but I try to remain objective because I didn't come into gold because I wanted to work in a gold company. I came into gold because I made money on the S&P as a speculator, as a hedge fund manager, and I realized that gold made more sense than fiat money. Bitcoin makes more sense than fiat money. Gold is just more stable for me. In terms of what happens with gold, even if you take my thesis, I'm completely wrong. Gold wins either way. That's what's interesting about gold. That's why even people have different views on the U.S. dollar, like Brent Johnson, than I do. We have the same view on gold. You take Luke Roman's argument that they're going to have to print more money inevitably to save the system. That's going to be very good for gold and Bitcoin. But let's say Luke and I are wrong and they don't print more money to save the system. They allow the bond market to tank naturally and yields to spike. That will destroy everything but the U.S. dollar. And so in that scenario, gold still does well. Typically people say gold needs negative real rates, it needs inflation, it needs a strong dollar to survive. But gold reached all-time highs despite those tailwinds not being present because gold is disconnecting from the old narrative simply because everything is not normal anymore. Again, that's not gloom and doom. It's just the reality. The Fed or the ECB or any major central bank is damned if they do, damned if they don't. There are no good scenarios. They can either debase the currency by super QE to the moon to save the bond market, or they can do nothing and let the bond market crash on its own, and then we'll go into a real depression, recession, and then gold will still do well in that scenario. Gold simply gets the last laugh because policymakers have failed to manage the balance sheets correct. Preservation or speculation, I think gold can do well in both categories. Always, for me, it's a preservation asset, but if gold goes from 2,100 to 4,200 in a year or a month or a day, you have to understand, too, that also means the price of just about everything else has gone up, too. So it's kind of an interesting consideration. Again, between now and the end game of, I think, much higher inflation, because I do think the central banks will have to liquefy the bond markets, there's still going to be a great deal of volatility. So the more general advice would be not just what asset classes, because stocks will do well when rates come down. Everything will inflate. And as the dollar debases, that will be a tailwind for equities. Then you have to pick your equities. The Magnificent Seven, to me, are still too overpriced, so I wouldn't buy at the top. I still believe in the old adage of find value. I think industrials and those type of stocks that still have good value would be good purchases. But most importantly, if you're trading your own account, then you should have some understanding of exits and entries. I think this is the end of the passive buy and hold portfolio because of so much volatility. You have to actively manage. You have to find value. You have to decide whether you're in this to get rich quick or to just preserve what you have. So those are kind of generic answers, but they're more important now than ever. The standard risk parity portfolio that many people use, I think, is very bad. I think long-term duration, long-term bonds, especially long-term U.S. Treasuries, are not going to be a good investment because interest rates or yields, whatever they are going to be eclipsed by the inflation that's coming longer term. That doesn't mean there won't be opportunities in the short term to arbitrage stocks and bonds. But again, there's going to be volatility before we get to a full pivot to full QE. And I don't know when that will be. No one does. I know it's inevitable. When there's this much need to support the bond market, there will have to be massive amounts of liquidity like we saw in March of 2020. That will be a liquefying tailwind for risk assets. But again, your yields on your bonds are going to be eaten away by inflation. So you're going to have negative returning bonds like we saw in 2018, 19. So it's a damned if you do, damned if you don't in that scenario too. And even the appreciation you're going to get in your S&P or your Canadian stocks and bonds, that's going to be eaten away by the real effects of inflation. So my view on inflation is it's inevitable. Where we are right now in the U.S., very low CPI print from the 9% to the 3%. But again, that's only chapter 2 of a much longer book. You have to think that if you believe in that premise. If the Fed or the central banks of the world don't liquefy the markets, don't go to QE to the moon, then just about every asset class is at risk except for the currency, the U.S. dollar.
During the interview, MatthewPiepenburg expressed concern about an overly optimistic view on bond and stock market safety. However, he is notably optimistic about gold markets, particularly when the Fed is expected to provide favorable support. Gold is also a rather unique asset compared to things like stocks and bonds, which also makes it act differently. And the fact that it operates as a hedge means one needs to look for factors that impact other assets differently. Furthermore, Matthew expected a move away from the higher-for-longer policy, projecting rate cuts' impact on gold, S&P, and the U.S. dollar. Swaps markets are now pricing more than an 80% chance of a cut by March, which would be bullish for non-interest-bearing assets like gold, though some central bank officials have pushed back on the prospect of early easing. He anticipated a Fed pivot post-banking crisis, citing concerns over the impact of higher rates on businesses and the government. Let's get back to the interview.
The bond market and the stock market is once again safe, and inflation has been defeated, and everything's fine. But again, if you're on the other side of the tracks and you've just been laid off, or you've lost your job, or your company's gone bankrupt, those jobs reports, if they're looked at more carefully, aren't so rosy. And again, it's not trying to be a sensationalist. These are just sad, hard realities. It really depends on whose perspective, who has a vested interest in being positive. And again, if I were a central banker or a politician, that would be my job. When you're working for yourself or with a group of partners where you're not constrained by a political party or you're not constrained by a board and you can see the facts, you can talk about them clearly. It doesn't mean, by the way, you have to be always bearish. The markets, I'm very bullish on the markets when the Fed is about to give you a tailwind. I'm very bullish on gold for a number of reasons. So I'm not just bearish across the board, but the recession indicators we've gone over many times, are clear and convincing to me. Full disclosure, like many, and myself included, we all kind of thought after the regional banking crisis in the U.S. with SVB, and that there would be some type of rate cut or pivot by the Fed in early 2023. And there was so much volatility on the short end of the yield curve that we were really, they called the BTFP program by the frickin' pivot, because the pivot was coming, and it didn't come. And Powell, for better or for worse, stuck to the higher for longer policy. Now, for a number of reasons, Powell is, before hitting target 2% inflation, before defeating inflation, is throwing in the towel on the higher for longer. That's why the announcement came out that they're expecting rate cuts. And I think the main reason is, first of all, it's not reported as much as it should be. At the higher rate policy that he was aiming for this year, 2024, there's $740 to $750 billion in bonds that have to be repriced. These are bonds from companies that are listed companies on the stock market. So they're going to have to reprice bonds or debt. If Powell's rate hike stayed where it was, they'd have to reprice at a much higher and more painful level. That's in 2024. That's happening. In 2025, there's another $1.2 trillion in bonds that are going to be repriced. If we stayed higher for longer, that would be brutally painful for those companies on the stock market, which would be brutally painful for the stock market. In addition to what's happening in these publicly listed companies, the private companies have to reprice their debt at higher rates. Powell's policy of higher rates was crushing business. And so the inflation story be damned, because we had to think about lower rates. More importantly, perhaps, is the fact that Uncle Sam, the U.S. government, can't afford higher rates for longer. So Powell is, before hitting target 2% inflation, and despite his war on inflation rhetoric, is already pivoting. He's already announced, we had the pause, now we're announcing the cuts. We can debate how many and how strong and how long, and nobody knows the final answer. I have strong theories on that. But The cuts are probably coming. That will be good for gold. That will certainly be good for the S&P. That will be good to kind of stave off in the short-term recession. But what it does is, if he's going to weaken the dollar, which has always been my thesis, every broke country, every broke regime has to weaken its currency to save its system. And in this case, the system is the bond market. I have not changed my opinion on that. The bond market will be quote-unquote saved. The S&P will be saved at the expense of the inherent purchasing power of the U.S. dollar. And that will be the same across other countries as well.
Today, the gold price is holding above support and could be ready for another phase of growth. Part of the reason for the growth spurt in the last few years has been the concern about an impending recession and the need for a safe haven asset. Considering these multifaceted factors, how do you perceive the trend of gold in the coming year? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.